Hello and welcome to the VegFest UK online for December, and for this panel that's going to be looking at funding for your vegan business. We are very thrilled to be joined by a number of guests for this, but in particular our host today, who is David Pannell from the Vegan Business Tribe. We're very happy to be joined by David. David has been doing some outstanding work throughout lockdown and is a regular part of the VegFest UK online shows. David, good morning.
Good morning, Tim, and how are you doing today?
Mustn't grumble. Yeah, it could be worse. Minor flooding in the kitchen at 6 o'clock this morning. Apart from that, it could be worse. So yes, looking forward to this panel and looking forward to this session. And I believe you have some pretty impressive little lineup of guests here to join us.
We do, absolutely.
I'll hand over to you actually and let you tell us all about the panel and the session.
That's brilliant. Thank you very much, Tim. And I just want to say also to Tim and his team at VegFest, they've done an absolutely amazing job over these past few months just to give people a platform, because it's been really a difficult time, for many of us this year, but especially when you're an events company like VegFest UK and all your business just disappears and you try to move it online. They've done a brilliant job to keep this platform going. So I think we also need to do what we can to keep brands like VegFest going until we can all return back to in-person events again. So I know that if you go to vegfest.co.uk, you can also donate through their Friends of VegFest scheme, and you can also buy a virtual ticket for this weekend for just £5. So if you've got a little bit of cash in your pocket, please go and do that. And that actually leads us today into today's panel's topic, which is raising funds for your vegan business. And I am joined by three absolute giants of a vegan economy who I'm going to introduce you to one by one in a moment. We have Claire Smith, who is she's a vegan impact investor and founder of Beyond Animal, Beyond Vesting, and Beyond Impact. And Claire just popped on my screen. Hello, screen. Hello, Claire. Are you good today?
Thank you. Yeah, I'm good. Good to be here.
Fantastic. So we'll jump back to Claire in a moment. We've also got Nick Mayhew, and now Nick Mayhew is the founder of VFin, and he's a vegan and ethical business funding specialist. Are you there as well, Nick? Can we just say hello quickly?
Hey, how you doing? Nice to see you, David.
Fantastic. And then finally, but by no means least, we've also got Mike Hill. And Mike Hill is the co-founder of One Planet Pizza and a very experienced business fundraiser as well. How are you doing, Mike?
I'm good, David. Thanks. Very well, yes.
Fantastic. Right, now I'm going to come back to each one of you separately and let you introduce yourselves properly. But I'd also like to just introduce myself as David Pannell. So I'm the co-founder, as Tim said, of Vegan Business Tribe, and I'm going to be hosting today's panel. And just to give us a little plug at Vegan Business Tribe as well, if you've got a vegan business or even just an idea for starting a vegan business, the Vegan Business Tribe, well, we're here to support you and inspire you, not just to have a vegan business, but to have a successful vegan business. And as our experts will tell us, there's a big difference between those two. And if you do head over to Vegan Business Tribe, you can get lots more content, just like today's panel, completely for free. And you can also find the Vegan Business Tribe podcast on Spotify, iTunes, or wherever you listen to your podcasts. And if you want to go beyond the content, then you can also join our paid monthly membership, which will give you access to join in with our live online networking events, our business clinics, our mentorship forums, and even to study our vegan marketing diploma to give you all the skills you need to get serious about getting your vegan business out there. Now, okay, that's enough of a plug from me. So let's get started with a topic. And I'm going to come to Nick first, if that's okay. So what we're going to be talking about today is how to get funding for your vegan business, because I think it's fair to say that a lot of people set up a vegan business as their way of aligning their personal ethics and their career. But I hate to say this, and I think I might get some agreement from our experts, but a lot of vegans just don't seem to like making money. We can think it's unethical to chase a profit, and especially if we're selling, to other vegans. But the truth is, you can do a lot more good in the world with a profit than you can with a loss. And money is always a little bit of a taboo when it comes to vegan businesses. But at some point, if you are wanting to scale up your business, or even if you just want to, test out a new idea, then you might only get so far through self-funding. So today, We're going to pull back the curtain on finance with our three experts. And I'm going to talk to each for about 10, 15 minutes about their area of expertise. And then we've also got some questions submitted by Vegan Business Tribe members, which will be open for anyone to answer. So I'm going to start with Nick. Now, good morning, Nick, and how are you today?
Morning, David. Yeah, very well. Thank you. Very well. Embracing this grey weather. So, yeah.
No, that's brilliant. Now, Nick is the founder of VFin, as I said, and you help vegan and ethical companies to raise money. And that's from traditional lending and financing through to crowdfunding campaigns. So, Nick, do you want to just take a minute to tell us who you are and what you do?
Yeah, so as you said, I'm Nick Mayhew, the founder of VFin. So for the last sort of 4 years, I've been working in finance to running my own commercial finance brokerage. Those 2 years were typically aimed at sort of your more traditional businesses, your construction, your recruitment, manufacturing, haulage, those kind of guys. And last July, I went vegan, sort of for animal and health reasons. And I got to the point sort of early this year, particularly when the lockdown happened, I realised my kind of values weren't aligned with what I was doing in the finance business. You know, it's all well and good to help a sort of construction business and, you know, you're still doing good things when you help the owners of those businesses, but there's no sort of wider impact than that other than helping that business and their staff and their family. I realised I wanted to do more. And I'd always been interested in veganism, sort of particularly like food and beverage businesses, cosmetics. And as you said, a lot of them don't necessarily have the right not aspect, but they don't have maybe the right kind of attitude towards their business in terms of profitability, and they don't give themselves the right chance to succeed. And when we were playing against all these unethical players and the big kind of meat players, and they've got all this knowledge, all this funding, we've got to fight fire with fire effectively. So that's maybe what made me want to go into VFin and start helping these vegan businesses raise the finance they need to grow, be profitable, and knock animal products off the shelves effectively.
And I think that's exactly what we spoke about in the intro, isn't it? About aligning your personal ethics with how you make a living and how what your business is. But there actually, you know, there are many ways a company can get access to funding. And I think the first thing that many people actually think about is going to their bank first. But I know that isn't always the best option, because this is just borrowing money that has to be paid back, regardless as if you're successful or not. So could you just give us a quick rundown of the different ways people can raise money for a business?
Yeah, I mean, there's a lot of different ways. I mean, bank lending is one method, and the banks are pretty strict on who they lend to. So if you've not got much in the way of assets or property in the background, or if you're a new company, you might struggle to get that initial kind of lending from the bank. For newer businesses, if there's some trading going on, you can look at some asset-backed financing. So whether that's kind of financing to buy assets you need to grow your business, or you've already got assets and you're looking to release some cash from them, that's another option. You can look at financing receivables. So if you trade with the likes of Tesco and they pay you in 60 days, you can borrow against that outstanding ledger, those receivables, get that money in faster, reinvest. It's kind of like it's called invoice finance. It's similar to an overdraft, but slightly different. For card payments, you've got something called merchant cash advance, which is basically invoice finance against card payments. Then you've got your likes of your unsecured term lending, which is just, here's some money, you pay it back over sort of 3 to 5 years. And then you've got your sort of more ones that seem to be more, I guess, quite popular at the moment. So that's kind of raising money from your friends and family. If you're fortunate enough to have some very good friends who have deep pockets, you can look at taking on investors, and you can look at crowdfunding, whether that's based on equity or rewards.
Yeah, absolutely. And I know you've got, as you said in your intro, you've got a history of working with helping companies navigate through these different funding options, because there's lots of different options. But I especially want to compare traditional lending through banks and lenders with this crowdfunding, because if you just go back 20, even 10 years ago, people might not have even known what the concept of crowdfunding is. So when is it right for a business to take on traditional lending from a bank or lenders? And when is it right for a business to look at something like running a crowdfunding campaign?
So I guess it depends on the reasons you need the finance and what, like the reasons you're looking to raise money. Because if it's something like you're looking to ease cash flow or provide some working capital, traditional lending can be a great way of getting that cash into your business, so that you're not selling a portion of your equity just to ease cash flow pressure. Equally, as if I was to invest in a business and I found that it was just for working capital rather than growing the business, I maybe wouldn't be so pleased with that, shall we say. So if a business has been used to trading on, say, cash on delivery, and then all of a sudden they land a big contract, I believe it's right to look at traditional lending, your invoice finance and those kind of things. But if you're looking to make if you've not got much in the way of assets, or you're looking to make some really you're looking to grow quite significantly, that's where I think sort of crowdfunding and equity investment has the best kind of best usage in that case, because you're not having to make repayments, so that doesn't impact your cash flow too much. But you can also raise more in comparison to what you could from a traditional lender. So if you look at, say, an unsecured lender, typically you're looking at being able to borrow about 1 or 2 months turnover. Whereas with something like crowdfunding or equity investment, it's more about the future, how the business is going to look in the future, what you've done so far, getting the alignment from the investors, and kind of selling that vision and that story, which may allow you to raise more than you could on a debt basis.
Yeah, absolutely. And just to repeat that point, did you say there that you could usually look to raise 1 or 2 months turnover if you go through traditional lending? On
average, yeah. I mean, if you look at something like receivables or asset backed, it's kind of dependent on the value of the assets and the value of the invoices. But if you're just looking at an unsecured term loan, 1 or 2 months turnover once you've been trading for sort of more than 3 years is about what you're looking at.
Absolutely. I'm guessing another big difference is that with traditional lending, that's usually tied to some kind of asset. So that might be assets of the business, but it can be your personal finances as well, can't it? It might be tied to your home. You might be putting up a stake there.
Yeah, and I mean, it can be useful if you really believe in the vision and your mission. It's a good way of focusing the mind, shall we say. It allows you to borrow more than you could, particularly if you're early stage. So if you've got a property with, say, let's keep the maths easy, for 200,000 of equity in, you can borrow 65% of that, 60% of that equity. You could raise 120,000. There's options you can look at, sort of interest only, spread that term over 10 years, which, can be good, but risky if it goes wrong.
So I mean, specifically on those timescales though, so what sort of time would you usually be looking for paying back finance through lending? Because if you've never taken on lending before, the only thing you might have to compare this to is something like your mortgage, and that might have been 25, 30 years that you get to pay it back. But in business, it's not usually that sort of length of term, is it?
No, so unsecured ranges anywhere from within 12 months to up to 5 years generally. There's a few that went up to 7 years for a period, but max is typically around 5 years for an unsecured lend. But a lot of the unsecured funders, they have these sort of quasi overdraft facilities. So you typically tend to service the interest over a 12-month period, but that capital is due back at the end of those 12 or 24-month term.
Yeah, absolutely. And so what sort of, because we've got so many options here, and I'm guessing that some of them are going to be also better for different levels of funding. So what level of funding is appropriate to each, or how much could you raise through a crowdfunding campaign, for instance, compared to traditional lending?
Yeah, so you can typically you'll be able to raise more from crowdfunding than you would from traditional lending if you're looking at it on an unsecured basis. If you've got a very asset heavy business, somehow you've managed to accumulate a load of assets, or you've got some significant property assets in your personal name in the background, then maybe you could raise more than you could on a crowdfund basis. But typically on crowdfunding we can see people raise quite a significant percentage of their turnover compared to what they could on an unsecured basis.
I'll push you there. Give me some figures.
Yeah, it's really hard to give figures because I don't want to be too revealing of companies I know in the background that have raised maybe 10 times more than their turnover, which was not legit, shall we say. But it kind of really varies, but you can raise a lot more because there's companies that do crowdfunding raises that are pre-revenue. And then it becomes more about the story, more about the work you've done in the background. So to be fair, it's hard to give a figure on that. It's more about the valuation of the business and how many shares you're looking to allot. So if you value your business at £1 million and you're willing to give away 20% of that business, then arguably you could raise 200,000 there. But then it's how you got to that valuation.
Yeah, of course. And I think we've seen crowdfunding campaigns going up to that level, haven't we? Where they're going, up to 100,000, 200,000. And that's, some people have gone even larger. But if you are just looking to, say, raise a few £1,000s, which a lot of smaller vegan businesses might, then I think the big thing is that's still not guaranteed under crowdfunding, is it? So you might put a plan in place that needs £10,000 to deliver that. And then you go down crowdfunding and the money just never materializes. But if you go to traditional lending from a bank, that's something where you'll get a very very definitive answer, and you can put that cash into your forecasting, can't you?
Yes, correct. Yeah, and there's a few lenders that will look on, at levels under 15,000. They've got auto decisioning models, so they can be quite quick to get that decision in a minute and have that cash that same day. So
same day cash, you just said there.
Yeah, can be. Yeah.
Yeah, brilliant. Which I think is something that can really help out. I mean, how long does it normally take if you're going through crowdfunding to get that money in the bank?
So if we're talking about a completed raise, then someone like Seedrs or Crowdcube typically does a due diligence period once a raise has been completed. They say it could take up to a couple of weeks to complete that, but I'd say anywhere within sort of 6 weeks you should receive your money. But if you're looking at planning a crowdfunding raise, then it's all about the planning. So you're typically doing something sort of 6 or 9 months in advance at least. If you want to have a really good raise. I mean, down at Your Heights recently raised, they raised £1 million in 20 minutes, but it wasn't 20 minutes going live on Seedrs. It was all the pre-work he did in the background, all the sort of schmoozing with investors and doing all that pre-work to allot those shares. So they were able to get that million in quickly. And then the investors on the panel of Seedrs then sort of carried the rest of that 800,000.
Yeah, absolutely. So what we're saying is, if you want the cash in now and you've got the assets behind you, then you can go to the bank and get that, that answer almost straight away. What I'd like to know, though, is from your point of view, Nick, because you talk to a lot of companies who are just looking to raise funds. What would you say the market trend is at the moment? Are people now coming to you saying we want to do crowdfunding, or is that something more that you're introducing them to?
A lot of people are asking about crowdfunding and equity investment. I'm speaking to people about a lot of things. To be fair, people are becoming open to the sort of more traditional lending as well, the asset-based stuff. I'm helping a company with to finance some assets for their business as well. So they're asking about a range of different things. But what I am finding is the ones that are asking for the traditional lending perhaps have already completed something like a crowdfunding raise in the past already. But I know I can say about 4 years ago when I first started prospecting into food and beverage, a lot of the companies we were talking to about traditional lending very quickly went on to do something like a Seedrs raise or a Crowdcube raise and were successful in that. So I think actually a lot of companies, particularly if they've got quite smart investors in the background, are sort of stressing the benefits of having both something like a crowdfunding raise for the marketing and PR benefits, but also invested in sort of your business in terms of staff, your own marketing, those kind of things. And then the traditional lending to help with your sort of cash flow and working capital, so that investors' money is not suffering cash drag and waiting for those invoices to be paid effectively.
Yeah, absolutely. And that's brilliant. But just to finish off, I'd like to know what you think, about what I said into my introduction. Do you think that was fair, that just when a lot of vegans are planning their business, they don't think enough about the making money part and, when the money's going to come in, and they struggle not appreciating that there are lots of options out there to get money if you want to scale up a business?
Yeah, I think it's fair, but I think it's also across the board in a lot of small businesses anyway, that particularly a lot of people start businesses because they see something in the world they want to change, or often it's because they don't like their boss and think they can do it better. So I don't think it's just strictly a vegan problem, but I think when we're doing something as important as what we're doing in veganism, and we've got this massive battle to fight, we've got to make, as vegan business owners, we've got to give ourselves every opportunity to succeed that we can.
Yeah.
I think it's fair, but yeah.
I 100% agree with that. So that's brilliant, Nick. Thank you very much. And just to repeat, you are Nick Mayhew from VFin. And if people want to find out more about you, where do they go? What's the best way to get in touch?
I'm pretty active on LinkedIn, which is just Nick Mayhew. I've got the website, which is vfin.io, and my old finance brokerage website still has a bit about what we do, which is peakbusinessfinance.co.uk.
That's brilliant. So thank you so much for your time there, Nick. Okay, I'm going to move on to our second expert now, which is Claire Smith. Claire is the founder of Beyond Animal and Beyond Investment. And now, Claire, you introduce yourself, and especially when we first spoke, you introduced yourself as an impact investor. So can I ask you to tell me exactly what you mean by that, and just give us a bit more information about Beyond?
Yes, certainly. So I define myself as an impact investor because the primary driver of my moving into this area of investment was to create impact, and to create that impact through investing in companies that were going to have this positive impact in the world. Without my investment, they wouldn't have been able to. And there's a number of companies in my portfolio that I and a few other investors, if they hadn't gone in for the first rounds, and some of them where I was the only investor, would not exist today. And I think that's obviously very kind of gratifying from my perspective. What I would like to sort of make clear is that what, as an impact investor, often you're going into neglected areas. So when I first started in 2016, there wasn't really that much investment into vegan businesses at all. And so, you're often kind of starting things going, whereas the regular type of traditional investors in VC will wait until they see some kind of a trend and see some market traction for these companies. And so we are seeing, obviously, we're seeing traditional investors all the way along, a lot of pre-IPO investors coming in now for some of the bigger companies in the space. But I think the important thing is that, as I said, you have to have the sort of early adopters in every business. You have to have the first movers to get things off the ground. So I think that's the definition really of the impact space, is that often they're the first people, and they're motivated more by, as much by the impact as financial returns. They have belief in the companies, and they have belief that it ultimately will be profitable, but they maybe have a longer time horizon than the traditional investment space.
Absolutely. And now I think the problem is, Claire, is that we're all now experts investing, because we've all seen Dragon's Den. And that's where people go in, they ask for £100,000 in return for 15% of a business. So it means that we all know how investing works, right? Is it different, though, in the real world?
Well, yes. I mean, I think we know that in any case with Dragon's Den, you see the clips on the TV, you see the edited down version. You hope that the dragons are doing a little bit more due diligence than that before they invest. And in fact, I think we all know as well that the dragons going in and saying, yes, I'll put that much into your business, and sort of like picking up their wad of cash, it doesn't mean that a deal goes ahead at that time. It then goes into due diligence, and quite a number of those deals have fallen by the wayside. They haven't been completed, either because of issues from the one side or the other, from the entrepreneur side or the dragon side, that they figured out that they don't want to move ahead, they don't get on, or they found some issues, other types of issues with each other. So I think that gives you a very kind of optimistic view of how your fundraise is going to go, if you think it's going to be as easy as that. I mean, I would definitely say to the companies that, definitely plan your raise and do as much work as you can before going out to any kind of investor. Obviously, you need pitch decks, you need a full financial plan, you need to not just pull numbers out of the air, but have good backup for your numbers. Identify all the costs that you think you're going to have, what salaries you're going to pay, office costs if you're doing that. And then on the revenue side, have good backup to those revenues. I mean, this is something the dragons often ask in terms of the revenues and where those revenues are coming from. But you need to be able to sort of project forward, see where you're going to sell the product to, and probably haircut some of those estimates as well, because you're obviously going to be optimistic. You're not always going to get the listings in XYZ supermarket or food service or whatever that you're anticipating. So be realistic as well.
Yeah, absolutely. And so when we're actually looking at investment, so as we understand it, it's either going to be an individual if it's an angel investor, or it might be a fund, which is multiple investors working together, and they're going to put a lump sum of money into a company for some kind of return. But it's not just that money you're taking on. You're also then opening your company up to the scrutiny of other people as well, because at some point that investor wants to see that investment grow. So just technically, how does that work? So when someone's putting money into your company, what are they expecting to get back?
They're expecting to get back a lot more than they put in, is the simple answer. And so how is that going to happen? It's going to happen by you growing your business, but at some point being able to allow them to liquidate, to monetize that gain. And how does that happen? If you want to hang on to your company, against all odds, then you're maybe not going to be too interested in a trade sale, for example. So maybe to, some large food brand like Unilever, who bought the vegetarian butcher in Holland a year or so ago. So that can, maybe you think that you can IPO, but there's only certain companies that reach the level of going to the stock exchange. I say that, but I have to say that there are actually some exceptions to that, and in certain countries there are really some quite small companies going on the stock exchange. A company that I invested in 2 months ago is considering going on to the stock exchange, and I was the first investor. So that's pretty extraordinary, isn't it? But it's a function of different stock exchanges in different companies in different countries. We're seeing some social stock exchanges as well, which are kind of prioritizing impact type investments. But yes, in some countries, the cost of IPOing is very, very low. And so some companies are finding it attractive, even if they're pre-revenue, to list on a stock exchange, because it facilitates them getting capital in the future, because the investors think, rightly or wrongly, that they already have an out, that they already have an ability to then sell they want to. In these companies can be very, very low, but they are this amount of retail interest and have gone up to some quite explosive valuations. So I think is more realistic. If you'd asked me a year or so ago, I said, well, you know, no company that is in my portfolio at that point is likely to IPO for, let's say, 3 to 5 years. Now I think that there's every possibility that some of these could IPO in the next 2 years, which is quite extraordinary, and is really a function of the stock market interest in this area because of the growth of the plant-based market.
And I think that's absolutely amazing to hear that it's a smaller company as well. But I'm guessing that, you know, part of the reason for someone looking for an investor, it is maybe, unfortunately, going back to that Dragon's Den thing of, you know, you want someone who's got more business skills than you being involved with your business. It is very comforting if you've got someone who's already built businesses themselves and sold them and done, you know, that explosive growth. But is that a fallacy, or are investors really that hands-on in the companies that they invest in?
Yeah, I think some investors can be very hands-on, and obviously, I think it very much depends on the amount of equity stake that they have. To be honest, if they've got a high percentage of your company into sort of double figures or so, then they've definitely got a big interest in ensuring your success, because their payout is obviously that much greater. So yes, companies should be doing as much due diligence on their investors, and previous to going out to an investor, definitely look at their LinkedIn profile, look at their background, look at any companies that they've been involved in the past. You'll see on most of the VC sites, including my own, you'll see a list of the companies that they've invested in, and some of them will say what has happened with those companies if there's been an exit. And that's all about them saying, you know, we're really good investors. We spot the good opportunities, which is a bit about them raising funds, but also from the entrepreneur side, they will often talk about how they are providing some kind of a sort of ecosystem around the companies, which is something that I try and do as well. And in fact, I'm actually expanding my ecosystem to the whole vegan market through the Beyond Animal platform, because there everybody can join and can interact with other vegan companies and learn from each other. And that's something that we hope will only accelerate on that platform. And of course, with people like you also on that platform, helping people on a day-to-day basis with the sessions that you were doing earlier. And we welcome any kind of club or network like that to do that, in order to provide that more localized and face-to-face contact with the entrepreneurs too.
Absolutely.
So we want to provide support to all vegan businesses, not just in the funding on Beyond Animal, but also in this access to other businesses, experts, and potential partners.
Absolutely. And sorry for jumping in there, Claire. But yeah, I mean, we love the Beyond platform. You know, we're on there quite regularly, helping people out, and we get involved in your events just as you're getting involved in ours. And it's great to have that ecosystem. But there does seem to be a lot of funding being put into plant-based at the moment, and especially into those meat alternatives. So would you say this is because investors are starting to develop a conscience, or is it, you know, homegrown people who are turning vegan, then looking for vegan options, or are investors just starting to follow the money?
I think, yeah, it's a bit of a hot area because of the explosive growth, which people are seeing come through in terms of revenues, but also when we see, as I said, this handful of companies that have also already gone onto the stock market, going to very high valuations versus their current revenues. Obviously, those valuations are based on the anticipated growth in those revenues, but they are building in quite a lot of optimism, let's say. If you look at some of the ones, especially some of the ones in Canada where there's tiny companies, small liquidity, their revenues are increasing, but they're expecting them to basically be it's a bit like, I don't know, the valuation of Tesla versus the other car companies. There's an enormous amount of optimism in the price because it's this new technology, new thing, and they see them, going forward and increasing. Whereas a lot of these other companies, I mean, the food brands, the food manufacturers are kind of perceived as ex-growth, and so their valuations are low. And I thought last year when I saw Beyond Meat, or even before that, before it launched, I was like, this is going to really kick up the whatever to the other food brands, because their CEOs are going to see the valuation for Beyond Meat, and it's only skyrocketed since then, and look at their own valuations and think, hang on a minute, I need to be doing something here. Not only for the investors. The investors obviously are kind of banging the door down saying, why isn't our valuation as high? But also for their executive share options. Their pay is linked to their share prices and the performance of their stock. And so this has really given them a prod to look at this market. So in terms of investors, yes, we're seeing investors come in, we're seeing more angels come in, more funds come in. I was rather shocked quite recently to understand that somebody who I have never seen in a cap table, who has never put a penny into this space, has managed to raise 100 million fund. So that was kind of, like, wow, okay. So people are so desperate that they will put money with somebody who has no actual experience in investing in this area. But anyway, there is obviously investor interest, and that investor interest is spreading into the corporate side with a lot of corporate VCs that have been quite non-present in this space up to now, starting to put people directly in charge of looking at venture investments in this area from
Absolutely.
a strategic standpoint, obviously.
Yeah, absolutely. And as we said before, a lot of this money seems to be chasing the next big meat alternatives, but probably the time to invest in companies like Beyond Meat to get the really big return some people have, that was probably 10 years ago, before they got to the valuation that they are now. So can I ask though, if you are a vegan business and you've not yet exploded like one of these companies, it sounds like investment still is an option and investors are out there looking for the next big thing. But what are investors actually looking for? Do you need to have actually proven a concept first before going out and finding someone to put money in, or are people still investing into ideas?
There's two types really. I think if you have something, if you're looking to go into the food and beverage space with a branded product, so something along the lines of a recipe or the pizzas that Mike has, etc. Then you need to have proven it out in some way first in terms of selling at least a few products to a few people. Maybe you started on a market stall, maybe you started selling to local restaurants or a small supermarket chain, but you need to have some kind of evidence of demand there. And then what the VC funds certainly, and most investors, if they're going in for equity, they will want to see that you have a scalable business. So they will want to have comfort that you are going to be able to expand those sales, grow those sales, that you won't be capacity constrained. I've very rarely invested in restaurant businesses, for example, because an individual restaurant is inherently capacity constrained by virtue of the fact that it only has so many numbers of tables and chairs. And the capital costs of then creating the second and the third, etc., are quite high. So something that is ideal in this area is a product that can be co-manufactured. In which case you can use manufacturing facilities and kind of turn them on if you can find those manufacturing facilities. And I know that there is some kind of tightness in the market in terms of manufacturing now, but conceivably you can find other co-manufacturers as you get demand and then build up those orders. There is an issue, obviously, if you're starting with a co-manufacturer, they need to know or have trust that you're going to be able to pay them. And this is where you get into things that Nick was talking about, like purchase order financing, which may be necessary And on Beyond Animal, we're putting in place some solutions for that also. But conceivably, that's a good time to invest. And I put money into two businesses, one called Mighty P and the other one called Jack and Bry, that basically had a very good product and had enough interest from the retail sector, retail for one, food service for the other, for me to want to go ahead and actually fund their first production. The other type of business is where there's a lot of IP. So some of the businesses that I've invested in are doing a lot of research. I have invested in Stellag. I know it's sometimes controversial within the vegan community, but other types of things like the precision fermentation, which is synthetically producing proteins, and also the algae space, where I've invested in companies that have patents to break down algae into component parts. And there, it's less about the revenue, more about the value of that intellectual property, which they can then either produce products out or they license out that IP in order that other people can produce. So there you can see valuations moving up. It's not about the revenue today, but it's about the value of their technology.
Yeah, and thank you for that, Claire. That's really important, because I know when I've worked with investing in the past, they've always said scalability and intellectual property are the two things that they're looking for. So thank you so much for that, Claire. We could spend hours on this because it's absolutely fascinating. But just to repeat who you are Claire Smith from Beyond Investment, Beyond Animal and Beyond Impact. And if people want to know more about you or even get in touch, where should they go find out more?
Okay, I think the best is just to join Beyond Animal. If you join the Beyond Animal platform, then you'll be getting our newsletter. You'll see where I'm speaking and other places that I'm speaking as well. You'll be aware we are launching the fundraising platform in the next month. So pre-register for that as a company who's raising, or as an investor. And we will be in touch very shortly with the offering, with the details of that offering. When it goes live.
That's absolutely brilliant. And thank you so much, Claire. That was a real insight. Okay, so we're going to now move on to our final expert. And once we've finished speaking to Mike, we're going to have some questions for the entire panel. But first of all, I'm going to introduce Mike Hill, who is the co-founder of One Planet Pizza, who is the UK's first vegan frozen pizza company. And now I believe, Mike, you can actually order One Planet direct to your door now throughout the UK, can't you?
You certainly can. OPP Direct, we launched it in January. It's almost as if we knew COVID was coming, but we didn't, honestly. But yeah, no, it started off very small scale, but it's at its peak, it was about 30% of our monthly turnover, and it grew 800% in 3 months. So it's a very important part of our business now.
Absolutely. And now I know that One Planet Pizza, you've been one of the real rising stars of the vegan food retail scene over the last couple of years. And part of that growth, you've been through a number of rounds of raising finance for One Planet Pizza in a number of different ways, which makes you a very interesting person to talk to about funding. So can you just tell me a little bit about One Planet Pizza, but also about what funding the company has gone through over the last couple of years?
Yeah, sure. So myself and Joe, most people know it's a father and son team. We came up with the concept about 5 years ago. We started producing about 4.5 years ago. And it was very much as Claire described, that we started off, I was actually running a vegetarian vegan restaurant at the time. So we had a kitchen handy enough. We started making the pizzas. We started doing tasting for the Norwich vegan community, which is very, very strong. And then we started selling it in a few local shops, which I knew personally. Norwich is very lucky to have 3 or 4 very good independent health stores. And then, it moved regional. We got up to about 15, 20. But sorry, just to take you back, before we launched, we actually thought, well, what's the best way to do this funding wise? And I must admit, I'm quite cautious. I quite like taking risks, but the businesses that I've been involved in the past have always grown quite organically and slowly. So, the story over the last 4 or 5 years has been about quite steady or organic growth, certainly not exponential like some other businesses. But I think we've got a very firm basis because we wanted to grow through independent health stores. That's our strength, really. Mm-hmm. And rather than take the pizzas and just put everything in to go into the big supermarkets with all the inherent risks on that, we've really grown up very steadily, 15, 30, 150, now having 450 independent health stores. before we got our listing on Ocado a couple of years ago, and before we got a listing on Whole Foods about a year ago, and a few and Co-op and a few other medium-sized stores. But I would say at least 50% of our business is still sold to independent health stores, both in the UK and across Europe now.
Yeah,
and funding-wise, sorry, David, go on.
No, I was just going to say, so I know you've looked at two different types of crowdfunding in the past, and you've done angel investing as well. Yeah. But let's just talk about crowdfunding first, though, because I know that there's two different types of crowdfunding. There's equity crowdfunding, where people are, in essence, being lots of investors all coming together and they're buying a share of a company. But then there's rewards-based crowdfunding, which is close to people pre-ordering a product or getting a reward for funding the business. So which one of those did you do as One Planet Pizza, and why?
Yeah, we did the equity crowdfunding. We were the first vegan business to do it, actually, in Europe at the time, because it must have been, well, yeah, it was 4.5 years ago that we did it. We only raised a small amount of money. We only raised £20,000. It wasn't so much the money that we did it for, but as Nick mentioned earlier, it's the story, the PR, and we ended up with 104 investors, average £200 each. But we used them to spread the word. So they were our people that we went to with the ideas and concepts for the new flavors, and it's been, pretty much all of them have stayed with us. We'll talk about our recent funding round in a second, and a few of them have decided to cash out now, as it were. But most of them, 90%, have stayed with us. And the reason I guess we did the equity was that, donation is a lot simpler. There's less regulations, but I just didn't think that people would have such a buy-in. And back in those days, it was a unique concept of trying to get vegetarians and vegans who weren't really investors to put in 50. I think the minimum was £40. So we've got a lot of people put in £40, a few people put in 200, 500. We only had 3 or 4 people that put in over £2,000. So we had this collection of people, and back in those times, pretty much all of them were vegetarian or vegans, because the money wasn't following the plant-based business sector at that stage. So it was, and we knew quite a lot of them personally. We had a few in mainland Europe. We even had one in Australia. We had a lot of interest from American vegans, but they couldn't invest because back then it was very difficult for Americans to invest in crowdfunding. So it was really, and it was a novel story to take to Cedars at that time. They've grown a lot. Since then, but back then it was a really nice story for them to have a plant-based pizza business on the platform.
Absolutely. And it's interesting what you just mentioned there, because I know some vegan businesses who have done crowdfunding campaigns and they've not actually been successful in raising the money, but they got so much exposure out of it for the business that they just still considered it a success.
Yeah, definitely. And I'd stress what I think it was Nick mentioned, that especially these days, the crowdfunding platforms really, it's a lot tougher, I think, now than it used to be, because it's much more established. There's more companies going on it. And really, you need to have, most of the time, they're looking for you to have perhaps 30, 40% of what you're trying to raise already in the pot. A lot of people don't realize that. You can't go along and say, I want to raise 100,000 and I've got 5,000 committed. Those platforms are really looking for you to have minimum 30%, because people often wonder why, when it launches, bang, straight away, it's 50%, and it's because of all the hard work that's gone into it beforehand. If you look at if you look at Vegan Kind and All Plants, who have done big crowdfunders recently, and look at the investors that have gone in, prior to going public, it's the usual crowd, the people that are very active in UK and Europe that have come in with some substantial figures to get them up to that 30, 40, 50%. And then, as Nick said, it's over to the database, and it's a much larger database now that Cedars, Crowdcube have, and to come on board and finish off the final 50%.
Absolutely. And I think what we're talking about there is a lot of those companies, they've gone down the investment route, haven't they? So they're asking people to put money in for part of a business. And I know that one of the downsides to rewards-based crowdfunding, which is probably what most people who haven't done crowdfunding before are more popular with, it's things like, the Kickstarters and the crowdfunders, things like that. That's really just taking sort of pre-orders, and you need to fulfill those orders after you've raised the money. So that might actually give you a little bit of a cash flow if you're going down that route.
Yeah, I think donation crowdfunding, could be, for example, a restaurant business, I think it would work really well, with a single business, a restaurant wanting to start off, or perhaps, go to their second one, because it's obvious that you could then, if people invest £100, you can give them £120 worth of food vouchers, can't you? We did consider it, but we just didn't think, well, how on earth are we going to reward people with frozen pizzas? Because back then we didn't think about delivering frozen pizzas to people's homes direct as we can now. Otherwise, we may well have considered it. The other thing I'd point out about crowdfunding is it's quite expensive. The fees that the platforms charge are significant. Much more than you would than going down an angel route or anything like that. So it wasn't too bad back then raising 20,000, but it's not really worthwhile going down the crowdfunding unless you're going to raise 50 or 100,000, just because they have a percentage fee, but they have a minimum fixed fee, and it just gets very expensive if you're raising a small amount of money through it. And also they've put the limit up. Back then, they were quite happy to do 20,000 raises. Now I think their minimum is much higher.
Absolutely. So how many rounds of raising has One Planet Pizza done now? Because I know you did that original raise for £20,000, but you've done other raises, and you've also brought some investors in as well, haven't you?
Yeah, we have. So I guess the history is, and we've done everything that's probably been mentioned. So I was lucky enough to have my own funding. So pretty much for the first 2 or 3 years, I lent the business, through directors' loans, a reasonable amount of money. We did the small amount of crowdfunding right at the beginning. About 3 years ago, we took on board an investor who was bringing other things apart from just the money, i.e. we talked about co-manufacturing and expertise in the sector. So they came on board about 2.5 years ago, and then for various reasons, VegCap then brought them out. So VegCap, Matthew Glover at Veg Capital, plant-based investment fund, they bought into us about 9-10 months ago, and then we've just literally, hopefully next week, finalizing our latest rounds, which I guess would really be our third round of funding. And this round we considered, whether to go back to Cedars and do the crowdfunding, and I think because we're quite attracted to that, because we've got a reasonably good brand profile, a strong father-son story. If anything, the brand makes us seem bigger than we actually are. A lot of people have heard about One Planet Pizza, and they don't realise actually how small a business we are, because we've been quite successful on social media. Joe does a great job on that. So we were quite tempted to go back and do the crowdfunding, but I guess with VegCap on board as a lead investor, they introduced us, quite successfully to the network, for want of a better word, of plant-based investors in UK and Europe, and so it was. I think A, it was cheaper, less fees to pay. B, it was probably quicker, and C, 1 or 2 of the investors also bringing along expertise as well as money. Although very interestingly, 2 of the larger investors in the round that we're about to close are not in the plant-based sector at all. They're angels that came through a local network based around Norwich and East Anglia, and they've actually ended up being 2 of the larger investors in this round. Neither of them are vegan. Neither of them have ever invested in plant-based before, but in some ways they were more open, I think, to the story and the opportunity than some of the seasoned vegan investors who are in UK and Europe. And Claire's smiling there. I could see that. But you know what? Sorry, go on, Claire.
I think some of us, some of us people who've been in it for longer, are kind of thinking that the best opportunities have gone.
Yeah.
Not gone.
No, I think you're absolutely right.
Because we were so early, we got the best opportunities. But I'm super happy to see more people coming into this space and providing this follow-on funding. With the best will in the world, the very small group of investors that were in it since the beginning. And I remember in early 2017, I was in a room in San Francisco. We had a kind of mini conference, but it was really just to sort of get to know each other and just see a few pitches. And there were literally maybe 30 people in the room. and those were the kind of core people who put money into the space from then. But you know, with the best will in the world, it wouldn't get as far as it needs to go with just those 30 people. You need to have more investors coming in. So I'm very happy to see other investors come in. And on the Beyond Animal platform, we will have, you know, we have a membership available to angel clubs as well, so that they can join in on these raises and immediately get sort of up to speed on all the deals.
Absolutely. Mike, just following up on this point, because we're using this word angel a lot, and that might be not something that, if people haven't gone into investing before, they don't quite know what that means. But this is, you know, basically an individual putting money into your business. So what kind of difference does that make to running a company? Because at that point, you're not just responsible to yourselves anymore, are you? You know, you've got a group of shareholders pretty much watching you over your shoulder.
Yeah, I mean, I guess we're going to end up with an interesting collection of shareholders, because we've got you know, a percentage owned by crowdfunders, we've got a percentage owned by an investment fund, Veg Capital, and then we've got a percentage owned by 3 or 4 angel investors. I think the answer to that is it just totally depends on the investor. You know, one of the investors who's come in, as I say, not vegan or plant-based, really doesn't want to know anything apart from, you know, some sort of annual report on how his investment's doing. But one of the other guys whose daughter is plant-based, and that's one of the reasons he invested, just because his daughter was buying the pizzas and loved them. And that's something to, you know, don't ever discount that little personal in. You know, the number of times, so all the people that invested in this round, they all came and visited the factory, and they all had quite a few samples of pizzas as well. So, you know, don't and some of them, even though they weren't vegan, as I say, they had daughters or sons that were very interested in the space, and that's so we always have this generation of investors that have been influenced by their children, who perhaps are more open and interested in being plant-based, and they're talking to their mum and dad and asking for vegetarian, vegan food, and that sort of influencing them up. But just to go back to your question, it just totally depends. So, you know, we are just about structuring the board, who's going to be our investment director, who wants what and when, and some of the investors will want a quarterly report, some won't want anything more than once a year. So it totally depends on the different angel, I think.
Absolutely. And that leads into the real burning question, which I think people watching this will have now, is how do you find these people? You know, how did you first get investors interested in your business? I mean, I know you did a lot of work on pitch decks and things like that, but were you actually going out and finding these people, or did you find that people were starting to come and find you?
A little bit of both. I would definitely talk, don't discount, and I hope people aren't, don't discount finding investment outside of the plant-based, you know, investment sector. Because the angel network that we approached, called the New Anglia Capital Group, and they have about 50 angels who are interested in investing primarily in local businesses. And so we presented to them. Another thing we haven't talked about is EIS. One of the things that we had was that we had some bad advice early on in our company, and we're told that we couldn't get EIS. I'll leave Claire or Nick to explain the benefits of that, but it is quite important. If you're going for investment from angels, having EIS is
what does that stand for? What does that stand for?
Enterprise Investment Scheme.
Okay.
And it basically makes it much more tax beneficial for UK individuals to invest in higher risk businesses. And so we recently discovered that we were eligible. We got our advanced insurance, and that opened the door to a couple of the angels coming on board. How do we contact them? Well, we actually went to our LEP, our local economic partnership. Every region in the UK has an LEP, and if you approach them, I think they're much more open to plant-based businesses now than they were 4 or 5 years ago. A lot of the LEPs have then angel networks associated with them, and the way it usually works is, you know, you've got your deck and your business plan, you send it in, and it goes through some sort of scrutiny, and then you get an opportunity at the moment to pitch online. And sometimes there's 30, 40, 50 angels who are sitting there and interested. And it only needs 1 or 2 of them to suddenly make that connection with your product, with your story, through that personal connection that I mentioned earlier. and that can sometimes be easier. And I think they're not as hard, they're not as scrutinizing plant-based business plans as hard as people probably like Claire are at the moment, because as Claire said, she got in early and had earlier opportunity. She'll get dozens of plant-based business plans and pictures. If you go to your local LEP, they may only get 1 or 2, so it's quite new and exciting to them.
That is absolutely fantastic, Mike. And again, this is, we could talk about this for a lot longer. And I know that if you do go to our website at veganbusinesstribe.com, we have spoken with you for a lot longer as well. I think we ended up talking for about 2 hours, and we edited that down to about 45 minutes. So there's so much information there. So thank you so much, Mike, for your time. And just to repeat, you are Mike Hill from One Planet Pizza. You are changing the world one slice at a time, I think you like to say. But if people want to find out more about One Planet Pizza, or even put an order in for delivery, where do they go?
Yeah, just go to the website. It's all our social media is One Planet Pizza, nice and simple. And we're taking orders for our Christmas special as we speak. We've sold 500 to date. The only pizza in the world with Brussels sprouts on it.
And that is absolutely fantastic. Right. Thank you, Mike, so much. And I think between all our experts there, we've got a really good overview of all the different options of, the ways you can fund a vegan business. But I also put a call out to some of our Vegan Business Tribe members to ask what questions they had about funding. So I've got some questions here lined up that I'm going to put to the panel. Now, we haven't got lots of time, so let's just see if we can get through a couple of them at least. But if you did submit a question and it doesn't get answered in this session, then just drop me an email on hello@veganbusinesstribe.com, and I'm sure we can set up some follow-ons to get some answers as well. So the first question we've been asked, if I just bring it up on my screen. So, okay, this is quite an obvious one, and I'm going to come to Nick first on this, but how do you decide how much money you actually need to raise? Now, I'm guessing if you're looking to buy something like a piece of equipment or buy some premises, for instance, then that's quite easy to work out how much you need. But if you just know that you need money to grow a business, how should you base those calculations?
Yeah, so it's what Claire touched upon in her intro chat. So it's looking at salaries, looking at capital costs coming up, and really putting in a plan of how you're going to use that money, and making sure it's enough, because you don't want to borrow 30,000 for a marketing plan and realize you need 50. But also that you're not, if it's something you're looking at borrowing, that you're sort of not over borrowing and you can afford to make those repayments. And so if that's something that's based on a forecast, I believe it's good to make several forecasts, a worst case, a mid case, and a best case scenario. But probably base it off your worst case, just in case, and see if you can still factor in those repayments.
Anybody else got a comment on that?
Yeah, I'll jump in there, because it's very interesting. I think that some people advise you to raise as much money as you can, but actually, one of the investors that's come on board said, let's raise as little as you need, because let's do as much as we can with as little money, because you've got to remember that you're giving away equity, and it may be great to get a big investor on board and get loads of money, but you may regret giving away that too much equity early on. So it's a really fine balance. You don't want to hold back your growth by not having enough money to expand. But equally, there's no point in raising money just for the sake of it. It's going to be sitting there in the bank account. So I think you need to be really targeted about and say, okay, we're going to raise 100, 200, 300, whatever it is, and this is why we need it. And make sure in your mind that it's definitely worth giving away what you need to give away in those early stages for that amount.
Yeah, I would agree. I think that there's definitely an interplay. Thank you. An interplay between this the raises in equity and also the debt. And it drives me crazy when I see companies that are growing immediately think that they need to make more equity investment, and they plan this big round when the part of that should be going into the debt financing that Nick was talking about earlier, particularly for the production. People should not be raising capital for production. I mean, if you have no revenues and say you've got nothing to base debt on, then fine, your first capital injection would be equity. But then after that, if you have the turnover, you should look to debt first before you then go on to equity. And raise as little as you need to in equity at the highest valuation you can, because if you can do that and then show more traction, then you can plan the next raise at a higher valuation. And so each time you are giving up less and less equity. Big thing to remember, you can only sell the equity once. Once you've sold it, you've lost it, it's gone, and you'll never get it back. And people think that there's high rates on things like purchase order financing, receivables financing. Well, there is the interest rate on equity is multiples of the amount of equity investment that you're receiving. Why? Because that's what these VC funds are expecting. They never go into a company unless they anticipate getting multiples of that amount back in return. And so against that, debt financing looks very cheap.
Absolutely. That's actually going to lead us slightly into our next question we've got here, which it's not just covering debt, but we've talked a lot about raising money for a successful business. But as we know, this year, gosh, it's been a hell of a year for so many different businesses. So if you are a company that's maybe facing some sort of distress, maybe you've gone into your overdrafts or you've gotten into debt, is any of the funding solutions we've spoken about a good route out of that for a business in distress? Or are you moving into thin ice if you're doing a crowdfunder, for example, just to clear the overdraft and pay for staff?
Gosh, David, most companies, maybe stretching a bit, a lot of companies that crowdfund aren't making the money. There's people see and hear a lot of great publicity about plant-based businesses, but a lot of them aren't making money yet. It's not all rosy out there, and it's quite possible to grow quite quickly and still, not be profitable. We all know, a lot of the biggest companies in the world don't make money yet. So I think it depends on the story. From a crowdfunding point of view, definitely, a lot of crowdfunding. I looked at one or two of the larger ones that went on Cedars recently, and the financial information that they were giving away to the average investor on Cedar was really interesting. They were just talking about growth and revenue. They weren't talking about profitability or break even anywhere. Yes. Now they just didn't want to disclose the fact that yes, they're growing fast, but they may not be getting any closer to breaking even. So certainly crowdfunding, is a route, but it's all about the story, isn't it? It really is.
Yeah, absolutely. Nick, yourself. So if a company was come to you, a vegan company, and said, look, we're looking for funding options to get out of distress, not to grow, what sort of advice would you give them?
I guess it depends what's triggering the distress, whether it's they've taken on too much debt and the repayments are killing them, for want of a better phrase, whether they've lost a big contract. So yeah, it really depends on what's causing the stress, because borrowing more money, there's this phrase I heard the other day, it was quite nice. It used to be called cash cow, but now they're calling them zombie companies. A company that's geared up with too much debt is just there to service its creditors, and that's it. So it's about identifying the reasons, looking at what's caused the distress in the first place. If it's something like they're taking out 4 or 5 business loans, can that be consolidated into one on a lower interest rate? To be honest, normally when you're at that point and you're in distress and you've lost some revenue, that's not really a great option. So maybe they'd have to look at something like an equity raise. But again, probably maybe Claire would agree here, but probably the worst time to raise money is when you really need it, because you're desperate. You're probably going to have to accept a lower valuation and you're against the clock. Whereas when you're not against the clock, or if you've got ample time to raise funds, that's probably when you're in the best position to do so. Yeah. But again, if a business is maybe in some distress because they've lost a contract, but they're heavy on assets, then that's something that can be refinanced. It really depends on what the issue is, what the stress is, and what's causing that pressure. If it's just payment terms, that's something that can be easily solved with receivables finance. If they've got a long lead time between receiving their stock or their raw materials, then purchase order or trade finance can help solve that issue. But yeah, it's about identifying what's causing the distress, because if it's a business that isn't viable and you just chuck money at it, you're just lengthening that.
Absolutely. Well, I mean, Nick, what do you think specifically looking at where we are at the moment in 2020 and the pandemic? The government in the UK, they are offering bounce back loans, and that's between, I think, 2,000 and and up to 50,000. Is that a good idea to look at something like that?
Yeah, I mean, it's the cheapest money we're probably ever going to borrow in our lives. On
It's
the best
interest-free for 12
terms.
months, isn't it, I think? Is it?
Yeah, so the interest is serviced by the government for the first 12 months, then it goes on to a 5-year term. I think they're talking about extending it for 10 at 2.5% interest rate. So you can borrow up to 25% of your turnover under that scheme, up to £50,000. And then on the larger ones, you're looking at the coronavirus business interruption loan scheme, which is not as easy to fund as the bounce back loans. Bounce back loans have limited checks. It's just making sure you're not committing fraud or laundering money. Yeah, it's a good idea. I mean, there's a clause that you weren't in distress in 2019. So if you take that money out, obviously there's no checks and there's no judgment here if anyone did take out that money while being in distress. But again, it's whether you're adding more debt onto a problem or whether taking on that debt's going to help you solve that problem. So it's key to identify what the issue is and take the right steps accordingly.
Yeah, absolutely. That's brilliant. Thank you, Nick. Now, just moving on to our next question. I'm going to come to Claire with this one. And Claire, if you've got any comments on the previous question, add those too. But we specifically asked about the ethics of funding. So I think this is a little bit of a nod towards Oatly when they faced a backlash from some of its customers when they took investment from Blackstone. And Blackstone have got a little bit of a mixed background in what else they've invested in. But can you really have much of a say about where the money comes from that's been invested in your vegan business? Is there enough completely green and ethical funding to go around?
Well, sadly, the answer is no. But I think people should definitely do that kind of due diligence on their investors. If they can, if they are really caught in a spot, then they may not be able to do that. They maybe have to take money from sources they might prefer not to. But I don't think Oatly was in that situation. I think it was a very sought after deal, and they could have done more due diligence. I would also say, in terms of ethics in funding, in the last comment on distress, on companies getting into distress, I have seen companies get into distress because of the bad practices of funders, of investors, and a couple of situations, ironically, with the same VC, where companies were dangled the carrot of, yeah, we're definitely going to invest, we'll be the lead investor, don't worry, and then either pulled out or gave very, very bad terms that none of the other investors would accept. And those companies, well, one went into distress, it's being bought out now. It's gone to one of its co-manufacturers are taking over the business and will be producing, they were producing the product anyway, they have deep pockets and they're taking over the brand and will be moving forward with it. And in the other one, they were bought out by an associated company, which again was a rather, let's say, murky situation. That VC Fund A, which is associated with Company B, and Company B ended up buying the brand of the company that VC Fund A had not gone ahead with their financing on. So when you talk about ethics in funding, there's the ethics of investors that are outside the vegan sphere, which can be called into question if they have investments in coal or deforestation and all the rest of it, which I think was the issue with Blackstone. But I think you also need to be aware that the ethics of people within the existing plant-based world they're business people, and some have run companies in the past. They're very savvy. They are not only in it for the impact, let's say, and so I would certainly be doing some checks and find out what had happened before to some of the previous investments that they'd made, and know some of these backstories.
Absolutely. And I think just being fair to Oatly, I mean, they made the counter argument that they wanted to show these large investment funds that they could get better return investing in ethical companies. And Mike, is that something that you're finding you're doing, because you're getting people outside of a vegan sphere investing in One Planet Pizza?
Gosh, I don't know.
It's a big question to end on, I know.
It is. I mean, I think the whole Oatly thing is really, really interesting, and it's interesting. And I do think Claire's right that I think that they could have, if they had to take a deal, then you could understand it. But there must have been other options, and you do wonder if why they didn't see that coming. And I know the counter argument that that they've put, but it seemed to come out a bit late. Anyway, who am I to criticise Oatly? They're arguably one of the most successful plant-based companies out there. In terms of where the money comes from, I think it's really important that you're happy with your funding, with your funders from an ethical point of view. At the end of the day, I think we're all in business. You started this session off by saying that profit and making money is really important. It is. It's important because we want to have a sustainable business.
Absolutely.
And if vegan plant-based businesses, grow exponentially and then crash, and the only plant-based foods that we could end up being able to buy is being made by, the meat and dairy giants, then I think that's a real sad, situation. And I think there's a risk that that's going to happen. If you take our pizza business, for example, we're now looking at moving into various Eurozone markets, and we're being asked to compete with a brand which looks very, very green, very ethnical. I won't say which one it is, but it sounds like it's made in a nice little kitchen in down in the south of Italy or whatever by a lovely old plant-based couple. It's actually made by Nestle, and so these brands, and they're who we're having to compete now. So we're making 4,000 pizzas a week in our production unit in Norwich. Sounds great. And we're having to compete with Nestle to get into, supermarkets in Germany, Scandinavia, etc. It's getting very tough to do that. I don't think that actually answers your question, but it's an interesting point, David.
It is absolutely. But Mike, and being fair, I've got another page full of questions. We could have gone all afternoon, but we are now pretty much out of time. So I'm going to wrap up if that's okay. So first of all, thank you so much to our three funding experts, and they were Nick Mayhew, who is the founder of VFin and a vegan and ethical business funding specialist. Give us a wave, Nick. Brilliant. Claire Smith, who is a vegan impact investor, and she's the founder of Beyond Animal, Beyond Investing, and Beyond Impact. Gives a wave, Claire. And finally, Mike Hill, co-founder of One Planet Pizza. Now, I'm going to ask Tim just to come back in and wrap us up in a second. But I was also David Pannell today, and I'm the co-founder of Vegan Business Tribe. And just to give us a little plug again, if you do have a vegan business or you're thinking about starting one, then come do join us at Vegan Business Tribe, because we're here to support you and inspire you through loads of great free content every week, just like this. Or you can also join us for our online networking events, take part in our vegan business clinics, study our courses, or even get help from Lisa and myself in our mentorship forums. And we've just got our podcast now on iTunes, on Spotify, or anywhere where you listen to your podcasts. So that's it. So Tim, are you there just to wrap us up?
Yeah, I've been really listening intently. Claire, especially thank you, because I got your emails and I've never had the opportunity to listen to you, and it was really, really interesting. I would be paying more attention to your believe you can get the emails beyond Animal, and you're Zurich based, I believe. Are you not in Switzerland or Lausanne or?
No, yes, the company is Lausanne.
Lausanne, yeah. So I highly recommend that. And Nick, thank you for joining us. That's really interesting. I've never met you, but I was listening, and I thought, especially you mentioned about the bounce back loans and some of that issues are really useful. And Mike, we've talked many times, and it was really interesting hearing you talk about some of the challenges you're facing. And it's just great that you've shared all that information for free. And I think, David, you probably agree with this aspect. In some respects now, what we've got is really, for vegan businesses, it's almost like a mental health support, because the trauma involved in managing businesses right now is excessive for a lot of people, and I think we've all understand that. And there's very little support in some respects that is genuinely honest, first experience by people who genuinely live and breathe their businesses, who quite happily share not only the ups but some of the downs. And I think all business owners right there very value that kind of expertise. So thank all of you for sharing that, and David especially, because I think we'll be doing some more, and indeed maybe covering some of those areas that you touched on, which is, of course, those areas of distress that are really, really tough to deal with. How do you deal with those issues? And some of the taboo areas that don't get talked about in business, for obvious reasons. But if one good thing has come out of, I say one good thing I can see has come out of the situation is the gloves have come off in a way, and some of the mystery of all of this has become actually completely open. We've seen huge companies go out in front of us. Debenhams, we've seen the whole Debenhams issues unfold in front of us, and I'm sure there've been many more. But we're leaving on a positive note because we are out of time. Again, I'd just like to say thank you, and thank you for people listening. There are some questions. If you want to ask questions, there's some questions. People will be there to answer. Join us for more another day. Thank you very much.
Thank you, Tim.
Thank you.